Hello, this is Heartofeconomy. Here we don't just talk about economy, we open up the heart of the system and look inside. What I'm about to explain today isn't just a scenario for markets, it's something that could change history. What if the United States raises the price of gold to $20,000 per ounce overnight? If a country, in cooperation with its central bank, suddenly increases the value of its gold reserves by trillions of dollars, this isn't merely a matter of doubt. This is a stone thrown into the entire global financial system, and what follows is a chain of endless ripples. So now let's unpack this scenario together, not just through technical details, but also with deep commentary, historical context, and what it tells us today. Gold revolution, what does it mean? What would it change? Gold has not just been a metal for thousands of years, it has been a standard of value for humanity. Even though the modern financial system has shifted to fiat currency, gold is still like a silent judge standing behind all currencies. Now, I ask you, if a country, for example the United States, unilaterally pegs the price of gold at $20,000, what happens? The first answer: the 2,060 million ounces of gold in its treasury instantly jump in value from $870 billion to $5.2 trillion. But this move isn't just a gain in value, it sent a clear message. The current value of the dollar was insufficient, we made a correction. Because revolution is a way to cover up past monetary mistakes. My take is this: if a country is revaluing its gold, it means its currency is no longer considered sufficient on its own. This is one of the last cards left in the system. How is this done? Simple mechanism, deep impact. Now, let's look at the technical side of this process. It's not as complex as one might think. In fact, it's rather sneaky. The Treasury issues gold certificates and sells them to the Fed. The Fed records these certificates as assets on its balance sheet. In return, money is transferred to the TGA, Treasury General Account. So here's the magic phrase: gold certificate in exchange for cash. Where does this cash come from? It's printed, digital, created. But here's what matters: this money is not created through new debt, but through a revalued asset. This method is officially defined in the Fed's Financial Accounting Manual. So, it is not a conspiracy. It's procedure. There is a small but critical distinction here. In QE, quantitative easing, the Fed buys bonds, but here, value is created directly based on gold. My analytical view is this: while it may seem like this move doesn't create new money, in reality, it injects new liquidity into the economy, and liquidity immediately alters economic behavior. So the impact of this action doesn't just remain on the Treasury's balance sheet. It sinks into the soul of the market. What happened in the past? What does history tell us? In 1933, Roosevelt confiscated gold from the public. Then he raised its price. People sold at a lower price. Government later wrote it up at a higher one. The difference? Public gain, individual loss. In 1971, Nixon fully removed the gold standard. From then on, the dollar was based not on gold, but on trust. But the years that followed this move brought high inflation and economic instability. What history tells us here is this: every radical decision about gold may look like a solution in the short term, but in the long run, it shakes the system's stability. What I see here is this: even though today's system may seem more sophisticated than the past, the underlying logic remains the same: manipulate the price of an asset to solve a problem. What happens after? Is a doom loop at the door? If the US revalues gold to $200,000 and creates $5 trillion for the Treasury, that money instantly enters the economy. What happens? Demand rises, prices surge, inflation ignites, bond yields skyrocket. The Fed re-enters as a bond buyer, and the cycle starts all over again. This is what's known in the financial world as the doom loop, a triangle of inflation, interest rates, money printing. Hard to escape, costly to endure. My observation: once this loop begins, the biggest loser is the middle class, because while incomes stay the same, prices climb. Those who can't invest lose wealth. So, gold revolution creates not just a balance sheet effect, but also a social class effect. The future of the dollar is trust at risk. The dollar is not just a currency, it is a symbol of a system. And that system is built on trust. If gold is repriced, the message is clear. We no longer trust this system, we are making a correction. That message doesn't just echo inside the US. BRICS countries start seeking alternative currency systems. The yuan, digital ruble, gold-based payment systems are activated. Global appetite for US bonds declines. My analysis: this scenario wouldn't mark the end of the dollar, but it could mark the end of the dollar's uncontested dominance, because systems always seek a leader, and leadership isn't sustained by power alone. It also requires trust. Gold holders, wealth or a trap? A gold investor may smile the moment they hear about revolution, but behind that smile lies serious risk. Storage costs rise, asset declaration becomes mandatory, gold enters the financial system trader, the state may seek control over the wealth. And remember, when gold's value increases, it doesn't protect you. When wealth becomes visible, the system targets you. My interpretative evolution is this: those holding physical gold must prepare not just for price effects, but also systematic pressure. This revolution may not enhance individual freedom, it may increase public control. Could this really happen? Is it legal? Yes. Technically possible? Absolutely. But will it be implemented? Here's where it leaves economics and enters the stage of politics, power dynamics, and international balance games. Let me be very clear. A country, especially one like the US that issues the global reserve currency, wouldn't take such a step arbitrarily, but only in moment of necessity. And that moment of necessity might already be forming. US public debt has surpassed $36.2 trillion. Interest expenses are approaching $1 trillion per year. Debt to GDP ratio stands around 120%. Credit rating agencies are putting US under pressure. Political polarization and election pressures fuel the search for short-term solutions. Looking at this entire picture, a plan like gold revolution wouldn't even be on the table under normal circumstances. But when traditional tools of the system stop working, such options start to rise among the extreme but executable solutions. Let's not forget, when QE, quantitative easing, was first proposed, almost no one took it seriously. Today, it's a routine policy tool for central banks. What used to be called a crazy idea can become standard policy in times of crisis. And geopolitics? Forces that don't want to see the dollar's global hegemony shaken may resist such a move, but domestic political pressure may push populist governments to play big cards, especially in election seasons, under slogans like "Make America Great Again." Such a symbolic yet systemic steps could gain massive public support. My professional and calm observation is this: this scenario isn't something that would happen overnight, but the systemic fragilities that have emerged since 2020 are causing such extraordinary steps to no longer be seen as far-fetched ideas, but as backup plans kept ready. So, today the probability may still be low, but every crisis redraws the boundaries, and among those redrawn lines, gold hitting $20,000 is no longer impossible. Only the timing, political will, and crisis severity will be decisive. Today, I didn't just present a theory about the rising price of gold. I opened a door to a system transformation, a trust crisis, and the dawn of a new era. Do you think this could actually happen? Or is it just a theoretical fantasy? Write your thoughts in the comments. This is Heart of Economy. Here we generate ideas, analyze, and debate. Subscribe, share, and let's think together. Because economy isn't just about money. Economy is about the future.